Greetings, tax tip lovers, and welcome to this week's top tax tactics in just 5 minutes. Come, gather round, people, and let's dive straight in and look at how to form a joint venture and the tax issues that creates. There are just four principal types of joint venture that you can pay thousands of pounds to a property expert to learn about, and there's a very special fifth one that you likely won't get told about. Based on what I've seen over the years, there are three fundamental requirements for any JV to succeed. First, there's trust. Second, there's trust. And a close third is trust. Please, before you enter into any JV, take time to reflect on George Washington's observation that it's better to be alone than in bad company. So let's apply a 100% discount to the property structuring course you don't need to invest in and just summarize a weekend's learning in 4 minutes and 17 seconds. Okay, here we go with a little help from Richard Starkey from the 9th of April 1971, and it don't come easy as we count down the 5 steps. Static at this week's number 5 is I don't ask for much, I only want your trust. You could JV with a business partner, maybe a family member, a friend or a colleague. Likely you all make equal investments and have equal voting rights. You spread the risk, but you use all your capital. Down at this week's number 4 is, and you know it don't come easy. You could JV with an experienced or expert partner. You're partnering with one or more people with the technical skills you lack, so your funds complement their expertise. Just inside this week's top 3 is, and this love of mine keeps growing all the time. You could JV with an experienced property developer or firm. It's a hands-off approach where you provide the funding and they do the work. Typically, this one does its own tax planning because you'll likely be left with very little profit. A new entry at this week's number 2 is, and you know it don't come easy. You could JV with an investor. Here, you're working with a wealthy individual or individuals who put up most of the money, typically takes the majority profit share, and leaves you to do the work. Staying at number 1 is the all-time classic, got to pay your dues if you want to sing the blues. Well, yesterday's home runs don't win today's games, as Babe Ruth famously said. You can choose any of those 4 JVs, and if you make a profit on any of them, you will pay capital gains tax or corporation tax and likely income tax. And then when you die, you'll pay another whopping 40% inheritance tax. Maybe time to ask for a refund for those course fees. Well, as Abraham Lincoln said, things may come to those who wait, but only the things left by those who hustle. JV option number 5, the one you won't be told about because it's where the real property tax experts operate, is to use the same rules of any of the other 4 JV structures I've outlined and create them in tax efficient vehicles enshrined in legislation and tax pre-approved by HMRC, where their exempt status may mean no capital gains tax or inheritance tax, and rents roll up gross. Well, life is a shipwreck, but we must not forget to sing in the lifeboats, as Voltaire said. Okay, that's it. If it's time to take action to revisit your property tax planning, then here's how. You can do nothing and stay in the exact same place and pay a shed load of tax unnecessarily, or you can follow the link above for a free power hour review with chartered tax advisors who are ex-PwC and ex-HMRC, and will make your property tax planning like it was our own. And that's our take on how to make tax your biggest single cost, or not, and why we believe you need to take action, tax tippers. So volume up, hop back to 1971 with Richard Starkey to tell it better than I ever could. All right, stay bright. Catch you again for breakfast next week. Ta-ra.